predetermined overhead rate is going to help us with is when we have more than one product. In this case, and how we would keep our overall books for L would be like this. Total cost. But what if we produce 2 or more products? Well, then how much of the rent is for product A and how much of it is for product B? How much of the electric bill for product A for product B? Well, the predetermined overhead rate will help us figure out what product A used 100 direct labor hours and product B used 200 direct labor hours. We can split the overhead amongst the 2 products. Predetermined rate, multiply by the direct labor hours for each product. Figure out the total cost of the product. Then we can get the profitability of each of our products, not just the company as a whole. Yes, that's how it's reported on the income statement. But internally, we need to know each and every one of our products, how well they're doing. So let's look at that. Let's look at multi-product companies. Alright, so ABC Manufacturing Inc. produces 3 gadgets, ACE, Best, and Champ, in 2 departments, machining and assembly. So basically the flow is these 3 gadgets they produce. They're whatever machining does to them, and then whatever, then they're assembled. Each product requires 1 hour direct labor for completion. And so we have this cost data for the year. Number of units, 25,000 for ACE, 15,000 for Best, 5,000 for Champ. Machine hours, 2,500, 1,500, 2,000. We have their direct materials. We can directly trace the materials that we put into ACE. We can directly trace the materials that we put into Best and the materials we put into Champ. That's easy enough. If you're making a chair, and if you make chairs and desks, you know what plastic goes into your chairs and you know what wood goes into your desk. You have that information. You can directly trace them. Thus, their direct cost. But the overhead. Well, the machining department, initially we were able to figure out the machining department has $900,000. Their electric bill, their supervisors, and so forth. Maybe they're in a whole different building, so we got the rent on that building. We know it's $900,000. The assembly department's $450,000. So total overhead we have for ABC Manufacturing is $1,350,000. It supports ACE, Best, and Champ. We can get our, we get our total cost for the company. It's easy enough to take that total cost, and we know how much we sell of ACE, Best, and Champ, and go on and do that income statement for ABC Manufacturing and report to the outside world. But internally, we need to know how ACE, Best, and Champ are doing individually. Should we continue making Best? Should we just focus on ACE and Champ? Well, we can't do that unless we know how much of the overhead ACE, Best, and Champ has. So we're going to start with what's called plant-wide allocation method. If I can make this clearer. Plant-wide allocation method simply means that for the whole entire plant, we're going to use one allocation rate. It's not going to change between departments. It's not activity-based costing. We have one rate, like we used in our example, the $7 per direct labor hour. So we need to determine the unit cost for each product, the allocation basis to choose from. We have machine hours and direct labor costs. So let's look at machine hours. So first we need some sort of it's not really predetermined in this case since we already have the cost, but predetermined rate. Predetermined overhead rate. All right, so we've got total overhead of $1,350,000. We're saying that we're going to use machine hours as our allocation base, our activity base, our cost driver. We're saying machine hours drive these overhead costs. So it makes sense as we run more machine hours that these overhead costs are going to go up. So our total machine hours, 6,000. Here you go. So total overhead divided by our machine hours says that our allocation rate is $225 per machine hour. All right. So then Ace, Best, and Champ, we can now figure out what is the total cost of each. Ace had 2,500 machine hours. We're allocating $225 per machine hour. So 562,500 of the overhead is related to Ace. $337,500 is related to Best. And $450,000 related to Champ. Total for the company, we had $1,350,000 in overhead. We need to know the cost of our three products so we know if they're profitable. Do some analysis on them. Now, yes, granted, we'll learn this towards the end of the semester when we start talking about relevant decision making. When we go to try to decide if we should get rid of Best, yes, some of this $337,500 isn't directly related to Best actually being there. Some of it is going to be like the whole entire factory supervisor. Well, his salary is being allocated amongst the three. Get rid of Best, you're not going to pay him less. So we'll talk about that more later. But for now, we need to figure out how much of the overhead should we apply to Best. How much of the overhead should be applied to Champ? We decided that our cost driver was machine hours, so we're allocating this overhead based on machine hours. So now we can take the direct materials that Ace had. We can directly trace that $1 million direct materials to Ace. That $375,000 of direct labor that Ace incurred. ACE now, 1,937,500. We produced 25,000 units. So we get a cost per unit of $77.50. Now compare that to whatever we sell ACE for, or able to sell ACE for, that sort of thing. I mark it up from $77.50 to twice ACE. Do the same for Best and Champ. Eventually do that, you get $67.50 as your cost for Best, and $160 for your cost per unit on Champ. Okay. But we do have other alternatives of allocating costs. Here we chose machine hours. What if we choose the direct labor cost? That's how we're going to allocate it. It's a viable alternative. When we do that, we need to figure out a new. So when we choose direct labor, we have to choose the cost because we don't have the hours. I guess we can figure out the hours, but direct labor cost. So we're going to take our overhead, divide it by the direct labor cost. Overhead, 1,350,000. Total direct labor cost, 675,000. So now our allocation rate is going to be how much overhead we apply per direct labor dollar. Now, normally what's going to happen is when you're going to read through your textbook, or you read through some other textbook, and you're going to suddenly see, when it's talking about direct labor costs, and when I'm going to try to post the answer, instead of saying the answer here is $2, saying that you're going to allocate $2 per direct labor dollar, they're actually going to give you the answer 200%. And they do that because you're talking about a cost. What's happening here is you're allocating overhead 200% of your direct labor costs. And it's the exact same thing. Just want you to be aware when you see an answer, 200%, and you're wondering why, well, when I use machine hours, I use 225 per machine hour, not, 225, whatever percent that would be. 200%. It's because you're dealing with applying a dollar per dollar. A lot of the textbooks like to just call it percentage then. I don't care, whichever way you want to visualize it. So now if we look at ACE, ACE had 375,000 direct labor costs. Well, if we're going to apply $2 per direct labor dollar, means we're going to apply 750,000. We add our direct materials of 1 million and our direct labor of 375. Total cost now is $2,125,000. Divide that by our 25,000 units. Now the cost is $85 per unit. So we notice something here. If you're looking for a man manager in charge of ACE, and you're being evaluated on cost control, well, you're going to push for machine hours as being the allocation base. And when we allocate all this out for best and champ, best will be $75 per unit. And champ's going to be $100 per unit. Well, now if you're champ, you're going to say, no, it's labor that's driving the cost. I'm sure of it. So we have a problem here. And this is the problem with using a volume-based cost driver in a plant-wide method. We may have some issues here. What's happening? ACE, best, and champ, they go through machining and they go through assembly. They may not go through machining and assembly exactly the same. Maybe machining is more machine-based, hence more machine hours. So maybe there is a relationship between the machining cost or machine hours and the cost of the machining department. And maybe because champ uses a lot of machine hours. They spend a lot of time in machining. Well, then once we start using all the overhead being allocated on direct labor, well, if they're using mostly the machining department's time, and machining's really, the costs go up because of machine hours, and they don't really have many direct laborers, well, of course, champ is going to be looking a little less, using a little less cost here when we apply using direct labor cost. It's essentially direct labor usage. So our alternative to plant-wide, our first alternative, plant-wide allocation method, is called departmental rates. The idea behind departmental rates are that they're going to help overcome some of this problems with departments using machining, being machine intensive, being electricity is going to go up as the machine hours occur, or maybe assembly is labor intensive because we actually have people in there putting stuff together. So you have to spend more time on related stuff with the direct labor. Direct labor actually causes the overhead to go up. So departmental overhead rates may help provide us more useful information. It's also called a two-stage approach, which we'll pick up a little bit more in activity-based costing. But what's happening? We have the machining department, and we have assembly. We have our whole overall overhead. Stage one is to take this overhead and figure out what goes into which department. This has already been done for us. We don't have to figure this out. And then technically, it would be the same because what's going to happen, you have an overall probably plant supervisor, that salary's got to be allocated between machining and assembly. But for now, that's already done for us. It was machining, $900,000 in cost, and assembly, $450,000. The plant-wide one really didn't care that there was two. We had overall overhead, and we just allocated it between ACE, Best, and Champ. Yeah, we had this breakdown, but we didn't use it. Now what's going to happen? Departmental rates, or the two-stage approach, says, okay, we had this overall overhead of $1,350,000. $900,000 of it was related to machining, $450,000 was related to assembly. Well, we can take this machining $900,000, allocate it to ACE, VEST, and CHAMP. And we can take this assembly $450,000, allocate it to ACE, VEST, and CHAMP. And we don't have to pick the exact same cost driver for both departments. We can go into the department and see what's more or less going on. Well, machining. Maybe they're more focused on machine hours. I'm hoping that's what the problem says. I'm just going to let you listen to me. Yeah. Machine hours. Assembly. Maybe they're more focused on actually having direct. They don't really hardly use machines at all. So why would we be allocating $450,000 on machine hours when there's no machines even happening there? So now we can choose its own allocation base, machine hours, because that cost driver fits better for that department. And we can choose the allocation base, direct labor cost for the assembly. And we can allocate these costs separately. It's essentially the same mechanics when you go about creating an allocation rate and applying it between the three products. You're just going to have to do it twice. Just add an additional step in math. But it's two-stage in the sense that you take your overall overhead, apply it to the department, then to the products. Versus the plant-wide, which is just one stage, because overall overhead is just being allocated to the three products. So when we do that, they decide to experiment the department-specific allocation approach, machine department, machine hours, assembly, direct labor cost. We're going to use this method to get the unit cost for each product. So we need two rates. So for the machining department, their cost was $900,000. Total machine hours was 6,000. So that comes to $150 per machine hour. The assembly department, well, that's where the labor was used. $450 in overhead cost. Direct labor costs were $175,000. I think it comes up to a bottom number. Are they around it? So it's the same. Would be percent, 0.667. So 0.667 cents per dollar, or 66.7%. So now we can go ACE, VEST, CHAMP. So overhead machining, it's $150 per machine hour. ACE had $2,500 machine hours. So $375,000. Assembly. At $375,000. Direct labor cost. Have their own direct materials, $1 million. Their own direct labor of $375,000 to get total cost. approximately, a little bit of a rounding here, $80 per unit. Do the same thing for Best and Champ. We're getting a little bit more accuracy here. How are they actually using those departments? How are those departments actually having their overhead increase? Well, machining isn't using any direct labor hours. Well, direct labor costs are not related to that $900,000 of overhead from the machining department. If the assembly department is not using machines, then machine hours is not causing that $450,000 of overhead costs that's related to the assembly department. So we have inaccuracies if we're going to use a plant-wide overhead rate. The next chapter we get to in activity-based costing is going to show, well, we may be still having a little bit of problems here that we can maybe get even more accurate information. But for now, I want you to understand, yes, if you have one product you're producing in one department, one single plant-wide rate is perfectly fine. Or if you have multiple products that go through similar process, we have one department, one thing going on, single plant-wide overhead rate, perfectly fine. Now, once you get into multiple departments and your products are being produced differently, or one of them is spending more time in a machine automated department and the other is spending more time in a labor-intensive department, using one plant-wide overhead rate is going to throw your accuracy off. It's going to make, depending on which one you use, one product look more profitable than it really is, and one product look a lot less profitable than it really is. So you're going to make poor decisions when it comes to how much resources you allocate to whichever product. How many advertising dollars are you going to spend? Well, you're going to spend more on the profitable product because you want to sell more of it because it brings in a bigger profit. Well, if you have your allocation rate on overhead wrong, well, you're throwing dollars at something that really isn't going to be profitable for you. You start looking at not understanding why isn't your net income going up. If I'm throwing all this advertising dollars on this product that's supposed to be so profitable, but I'm not seeing these results, well, it could be because that profitable product really isn't as profitable as you thought. And that could be because of your overhead allocation method. Okay? This overhead. Starting to become really important in companies because of what's happening. I know you're saying there's not so much manufacturing in the U.S. Well, that manufacturing that does incur, what happens? Very automated. And a little bit less labor intensive. Well, what does machines require? Well, they require electricity. They require maintenance. They require depreciation or rent. These are all this overhead number that keeps getting larger and larger, whereas a direct cost, such as direct labor, starts getting smaller and smaller. So our prime cost direct material plus direct labor used to be really our main focus, and the overhead was just secondary. Wasn't really that much of it. Yeah, we had to run the air conditioner for our labor workers. We had a supervisor or two. But our biggest cost was put into whatever goes into the product and that labor. So it didn't really matter how we applied overhead if it's a small number compared to our total cost. Now, as we start having our overhead number get larger and larger because we're becoming more automated in those supporting activities, we don't pay the machine per hour. It's not a direct labor thing. We pay it for it up front and depreciate it out, or we rent it out, which is overhead. It becomes more and more important how we allocate that overhead between our products to figure out their profitability. Which also has all those other problems on when did the actual costs come in and trying to smooth it out. That initial discussion is why we even start with this whole predetermined thing. And now we go and look at how we allocate it out amongst our products. Another little key term you might want to know for later on. conversion cost. That's the direct labor plus overhead. Conversion, what does it take to convert your raw materials into your final product? Well, it takes you putting some direct labor into it and some of that supporting activities into it.